When people first start investing, they almost always run into the same dilemma. Do you put money into the market consistently, or do you wait patiently for prices to fall before jumping in? This debate usually comes down to two popular approaches: investing on a schedule versus waiting for market pullbacks. Both sound reasonable on the surface, but they lead to very different outcomes in the real world. In this video, we'll break down how each strategy works, walk through realistic examples, look at long-term data, and explain why investor psychology often matters more than market conditions themselves.
Welcome back to Marcus, where we simplify investing concepts so anyone can understand them.
And as always, this video is for educational purposes only and does not provide financial advice. Let's start with the strategy most people hear about first. What is dollar cost averaging? Dollar cost averaging, often shortened to DCA, is a method where you invest the same amount of money on a fixed schedule, such as every month or every paycheck, regardless of what the market is doing. For instance, instead of waiting for the right moment, you might invest $500 at the start of every month into a broad market fund. Sometimes prices will be higher, sometimes lower, but you invest anyway. The biggest advantage of this approach is that it removes emotions from the process. You are not trying to predict short-term market moves. Over time, your purchases naturally balance out, since you buy fewer shares when prices are high and more shares when prices are lower. This strategy works especially well for people with steady income who want to build wealth gradually. It encourages consistency, reduces stress, and helps investors avoid the common mistake of staying on the sidelines for too long. Now let's look at the alternative. What does buying the dip mean? Buying the dip takes a very different mindset. Instead of investing on a schedule, you hold your money in cash and wait for the market to decline before investing. The logic is straightforward. Why buy today if you can buy cheaper tomorrow? The problem is defining what actually counts as a dip. Is it a 5% drop? 10%? What if prices fall and then keep falling? Or what if the market rebounds before you ever invest? Successfully buying the dip requires accurate timing and fast decision-making skills that even experienced professionals struggle to execute consistently. Many investors wait for a bigger drop that never comes, leaving their money uninvested while the market moves higher. Over long periods, markets have historically trended upward. That means hesitation often carries a hidden cost. A simple comparison. Imagine a hypothetical scenario. Alex and Jordan each plan to invest $6,000 over 1 year. Alex follows a dollar-cost averaging plan, investing $500 every month no matter what the market does. Jordan, on the other hand, keeps his $6,000 in cash and decides he'll only invest after the market falls by at least 10%. Early in the year, the market declines about 8%. Jordan believes a larger drop is coming, so he continues to wait. Instead, positive economic news sends prices higher, and the market recovers without ever hitting his target. By the end of the year, Alex has been invested the entire time, benefiting from both downturns and recoveries. Jordan, meanwhile, missed most of the market's gains because he was waiting for the perfect moment. Even in years with significant declines, accurately investing at the lowest point is extremely difficult. Being early or late can dramatically reduce the advantage of buying the dip. What the data shows. To understand how these strategies play out over time, consider a long-term analysis conducted by a major investment firm. They examined how different investors would have performed over a 20-year period by investing the same annual amount into the S&P 500. One investor had perfect timing, always investing at the lowest point of each year. Unsurprisingly, this produced the highest ending balance. However, an investor who simply invested their money immediately at the start of each year came surprisingly close to that perfect result. Another investor used dollar-cost averaging, spreading investments evenly throughout the year. This approach also performed strongly, finishing not far behind the lump sum strategy. Even the investor with consistently poor timing, buying at market highs, ended up with substantial growth over 2 decades simply because they stayed invested. The worst outcome came from the investor who waited in cash year after year, hoping for the ideal entry point that never arrived. The lesson is clear. Time in the market matters far more than timing the market. Which strategy is best? From a purely mathematical standpoint, investing as early as possible often leads to the highest long-term returns, but real investors aren't robots. Dollar-cost averaging remains popular because it aligns with human behavior. It reduces anxiety, limits regret, and prevents emotional decisions during volatile periods. Many disciplined investors use a hybrid approach, investing consistently while keeping a small reserve of cash for major market downturns. The key is avoiding endless waiting and staying engaged with the market. Legendary investors have echoed this idea for decades, emphasizing consistency, patience, and simplicity outperform complex strategies for most people. Final thoughts. Your investment strategy isn't just about numbers, it's about mindset. A plan you can stick with through good times and bad is far more valuable than a strategy that looks great on paper but fails under pressure. If you found this breakdown useful, consider liking the video and subscribing for more investing content explained in a straightforward way. I'd also love to hear from you. Do you invest consistently, or have you tried waiting for market dips? Let me know in the comments. Thanks for watching, and I'll see you in the next video.